Welcome to Lesson 4. If Lesson 2 was about the rhythm and Lesson 3 was about the zone, Lesson 4 is about certainty. We're going to talk about confluence. In the world of professional trading, we never rely on a single reason to enter a trade. We look for a stack of reasons. The more layers we add, the higher our probability of success. Confluence is simply the art of combining multiple independent signals that all point to the same trade decision. Our goal is threefold. Filter. We want to weed out the noisy, low probability setups that lead to paper cuts. Focus. We only want to deploy capital on high probability trades. Confidence. More confirmation leads to higher conviction, which allows you to hold through the natural volatility of a move. A liquidity flip zone is actually our first major confluence. It's where Fibonacci retracements and extensions meet. So, how do we build a confluence stack? We look for the overlap. Imagine several transparent layers stacked on a chart. One layer is your Fibonacci levels. The next is your wave structure. Then you add support and resistance lines, trend lines, or maybe a 50% wick level from a previous candle. If all these different tools, which have nothing to do with each other mathematically, all say sell in the exact same $100 price range, you don't just have a trade, you have a high conviction setup. Key idea: the more signals align, the stronger the trade. Why go through all this trouble? First, it reduces fake signals. Relying on just one indicator is like driving a car with only one mirror. You're gonna miss something. Second, it improves confidence. Look at the silver or BTC trades we discussed. Do you really know if silver will drop to $58? No one does. But when the system gives you 5 reasons why it should, you have the psychological strength to stay in that swing trade until your target is hit. Lastly, it defines your risk. Clear confluence helps us find the exact invalidation level. If the price breaks through a zone where 5 signals converged, the trade is dead, and we exit with a small, logical loss. The TI system isn't just about Fibonacci. We stack it with volume analysis. Is the big money actually moving? MACD and divergence. Is momentum fading? MFI and squatting patterns. Are we seeing a struggle at the peak? Candle patterns. Are the candles themselves showing exhaustion? Price gaps and 50% wicks. These often act as magnets for price action. Individually, these are just indicators. Together, they identify a trading zone that the market is highly likely to respect. To take it one step further, we don't just look at one chart. We analyze higher time frames, like the daily or 5-hour, to find the big picture confluence. If the daily chart shows a major liquidity flip and the 5-hour chart shows a MACD divergence in that same spot, our confidence skyrockets. We use the big picture to set the direction and the smaller time frame to find the perfect entry. This top-down approach ensures you are never swimming against the tide of the broader market.